Welcome back. While the markets may already appear to be volatile, the rest of this week has some pretty big economic events on the calendar. We have inflation, PCE numbers that will be released, durable goods, and then GDP figures. So I thought it might be helpful to take a quick scan back at the charts to see where we stand in terms of the different markets, and maybe this will help us set up our expectations for these very, very big economic numbers soon to be released. The following chart shows us the S&P 500 in terms of their individual components. The 500 yellow dots represent the stocks in the S&P 500 on their own respective RSI range of 0 to 100. Above 70 is considered to be overbought. Below 30 is considered to be oversold. The last time we saw this chart, it was very equally spread out along the dotted line in the middle, the 50 level. You can see there's just a slight change, more of a negative tone. More of the dots seem to be between the 50 and 30 level, and even quite a few of them have drifted below the 30 level. There seems to be, in terms of the relative strength of the market, a little bit more of a weak tone. Take a look at the RSI components in terms of their own bracket. Now, we see the highest histogram bar here shows us 89 stocks with an RSI of 40 to 45. We have another 83 stocks between 35 and 40, and another 77 stocks between 45 and 50. So we can see the vast majority of the stocks in the S&P 500 have a relative strength reading just below 50. It is, again, somewhat of a weak tone. Now, I know the markets have been up one day, down the next, but overall there seems to be a little bit of a negative momentum on the stock market. In terms of the bonds today, the Treasury market, we can see this is today's change. Just a slight tick to the downside in terms of yield. The 2-month was down 9 basis points. The 1-month T-bond down 2 basis points, almost flat for the day. This is not a big deal. Current U.S. Treasuries, though, really show us the unbelievable divergence. While the 10-year stands at a 3.7% interest rate, the 1-year is at a 5.06. That's a 136 basis point spread, negative inversion, where the 1-year bond pays 136 or 1.36% more than the 10-year does. Take a look at the 1-month T-bill at a 5.67. This broke just above 5 just not too long ago. Now at a 5.67. The 1-month T-bill has been skyrocketing in rates. So some of the perception is that if Congress, is not able to reach some sort of debt ceiling agreement, traders are selling those very short-term securities as a result. Now, we can speculate the reasons why, but this is what's happening in the market. This is a 1-month percentage change in treasuries, 45% explosion in the 1-month T-bill yields, moving higher. Everything else seems to be trending higher, but just to a very slow extent. This is the 1-month change in bonds. The black dotted line represents the 1-month T-bill. Just the other day, it seems, we had the 1-month T-bill April 27th, about a month ago, had a 4.27 yield. Again, right now we're at a 5.67. That is a huge surge in yield. The rest of the bond market's been very quiet with a slight tone to the upside, but that is really where the capital is moving, out of the very short-term T-bills. Here is the 10-1 spread. The black histogram bars show us the spread between the blue line, which is a 10-year treasury, and the red line, the 1-year treasury, in terms of yield. Notice these two lines are drifting ever more apart from each other, and that is reflected by this negative yield. This is the lowest low we've seen in yield, meaning the largest spread. Now, we've talked about this in the past. The reason why this is happening is because the bond market is perceiving in the short term, the Federal Reserve may continue to raise interest rates. In the long term, in terms of the 10-year, it sees lower interest rates on the horizon. The red line is the 1-year, the purple line is a 10-year, the white histogram bars in the background, that's the S&P 500. Again, we can see up one day, down the next. The black line shows us the 1-month T-bill. That really shows us to the extent and the volatility that the 1 month is playing. And this all came about, if you recall, from the last was the Federal Reserve meeting, GDP, durable goods, non-farm payrolls. In a very short amount of time, we had all those numbers. And at the moment, at that time, it was perceived that it was thought that the Federal Reserve was done raising interest rates. Well, as a result of all those numbers and many more, the perception changed. And the market said, oh, maybe there's more interest rates in a near-term future. So the black line, the 1 month T-bill, which we're going to revisit a lot, is really kind of the signal as far as which way the market's going. Think of the 1 month T-bill as sort of like the head of the snake. If it turns to the left, then the body will follow. So right now, the 1 month has turned higher, and it's perceived that if that's the case, well, it is, the red line, the 1 year, is following. Will it drag the 10-year yield up? Not really, because the 10-year, again, reflects the long-term perception of the markets. Now, of course, when we talk about bonds, I think it's also important to talk about the mortgage spread. It's a comparison of the 30-year mortgage rate, the average 30-year mortgage rate, versus a 10-year U.S. Treasury. Now, of course, we know under normal circumstances, we'd expect the 30-year, the longer-term maturity bond, or in this case, average mortgage rate, to be higher than the 10-year, which it is. The difference between the two really reflects the state of the housing market, the banking sector, and the level of risk. Because when we look at the red line, the 10-year Treasury, that's below. The blue line is the average 30-year mortgage. But when we go to the bank and we say, okay, we want a mortgage, we want to buy a house, they're going to look at our credit worthiness, but they're also going to look at the general economic condition, because we're all sort of connected in terms of the economy. And the bank is going to ask themselves, well, what is the chance that this lender or this borrower will be able to pay back their loan? When conditions are good, the answer is very good chance they'll pay back the loan. Therefore, the bank will set the mortgage rates closer to the 10-year Treasury, still above it, but closer. But when economic conditions are sort of wavery, and maybe not so stable, they're going to put an extra amount of insurance into the 30-year mortgage rates. That's why sometimes when the 10-year Treasury goes down and other yields go down, our mortgages don't go down. That's because there's extra risk out there. Well, the yellow histogram bars show us the average mortgage spread, which is 2.67%. That's the difference between the average 30-year mortgage and the red line, the 10-year Treasury. That's a little bit lower than we've seen in the past, meaning, May 3rd when we had a 305, but still, current rates at 267, we're going to see in a moment, are not that good. That's actually a very high mortgage rates. Historically, take a look at what we see. This goes back to 2013. Blue line is the 30-year mortgage. The red line is a 10-year Treasury. The purple histogram bars in the background, that's the mortgage spread. And we can see 2013, we had a mortgage spread below 2, a sub-2 mortgage spread. The difference between the 30-year mortgage, 10-year Treasury was less than 2%. All the way up to 2018, 2019, all of a sudden, we had this panic, 2019, 2020, mortgage spreads rallied all the way up to about 2.5%, a little bit higher than 2.5% at the peak. Well, we're higher now than we were at the highest point of the panic of 2019, 2020. That really does tell us something. We see the two lines skyrocketed as a result of the Federal Reserve raising interest rates. After all, they're linked to the Treasury fixed income market, so both go up, but we can see the spread between the two. Again, this reflects the uncertainty in the banking industry. Mortgage spreads in the S&P 500 experience a almost perfect inverse correlation. When the S&P 500, the red line goes up, mortgage spreads stay low. When the S&P 500 falls, the mortgage spreads rise. Right now we can see, the S&P 500 is kind of trending higher, ever so slowly maybe, over, at least going back to October of last year. Mortgage spreads aren't really falling though. They're kind of holding in there. That really does tell us something. If we were to measure this rate of change, I would venture a guess that while the S&P 500 is chugged higher, mortgage spreads haven't fallen. I think that shows us The banks still see a lot of risk out there. And in case you're curious about the average mortgage spread, I believe historically the average mortgage spread is below 2%, around 1.7% in 2014. That goes back many decades. Going back over the past 10 years, we can see the average mortgage spread was 164 in 2014, 171 in 2015. 163 in 2018. Well, we had the COVID crash in 2020, then up to 223. Our current mortgage spread, the average for this year, 2023, is 278. In the month of May, current month, the average mortgage spread is 286. That really does show us something. It really shows us there is a lot of risk built into the mortgage markets. So while I know we had new home sales and the number on the surface looked good, the banks that reflect their opinion through the mortgage spread are telling us something different. Now, as long as we're talking about risk, we might as well also talk about the VIX, the volatility index. Measures the premiums on the front month options in the S&P 500. It's also known as the fear index. It's shown here with the white histogram bars. Now, when the stock market goes up, traders just buy and hold stocks. But when the stock market goes down, traders get nervous. They may buy protective calls. Or protective puts. They may sell covered calls. Point being is that the premiums on the options tend to go up when the stock market goes down. Now we're going to see currently the VIX stands at 17. That's a very low number. I think it's actually surprising that the VIX is so low given the amount of uncertainty. But then again, the stock market's been quiet. And when the stock market's quiet, the VIX doesn't measure emotion. It measures a premium on the S&P 500 options. So, and on the front month, meaning what's happening soon. So it's telling us that right now, the stock market is very complacent. It's not really anticipating any sort of downturn, or at least it hasn't experienced any sort of recent downturn. Here we see the S&P 500 with a white dotted line. The red line is a 20 simple moving average. The yellow is 90. We're just hanging out there above and right on the 20 simple moving average. The 20 is above the 90, which indicates a long-term trend to the upside is intact. And again, the VIX, 17. It's a very low VIX. Take a look at 2020. This was the end of 2020. Of course, we know what happened in the stock markets. Before that, 2019, the VIX went very much parabolic up to the 83 level. But we settled back down, and as the market chugged higher, the VIX settled near the lows. But even at the lowest point, the VIX was not really, it was around the 20 level, 25 at one point. We're at 17 now. It indicates a much more complacent market. These are the most common VIX levels over the past 8 years. The most common level you'll see the VIX over the past 8 years is 10, 15 in that area. Now, keep in mind, except for that very fast market crash in 2019, 2020, outside of that, we've had very strong markets for the past 8 years, going back to 2015 through present date. So the point being is that over the past 8 mostly strong years in the stock market, we've seen very low VIX. We're right in there right now. But if you're curious, how does a market act at these VIX levels? Well, this is the forward, or the average returns, we should say. The average returns of the stock market based on particular VIX levels. So right now we have a VIX around 17. The green line shows us the average 90-day return. Meaning when the VIX, or it's actually 15, but pretty close. When the VIX is at 15, that indicates that on average over 90 days, the S&P 500 only returned a 3% return. Now that's on average actually for the year, because if you think about 90 days, that's a quarter. And if we expand that out for the whole year, 3 times 4, so indicates about a 12% return for the S&P 500 over the course of the year. Meaning that right here is where we historically expect the S&P to perform for the year. 3% a quarter, 12% of the year. The S&P 500 over the past several decades returns around 10-12% for the year. If we see the VIX start to rise, it means the stock market would have gone down. And that indicates that, well, now the VIX has, more, it has gone up, and the stock market therefore has more room to go back up. If the VIX is up, it means the stock market's gone down. But right now, because the VIX is so low, it means the market has not gone down. It's very, I don't want to say strong because it's not the right word. It's complacent, that the trading ranges are very small, that the market hasn't moved a lot. That's why the premiums are very small. Historical volatilities are very small. The implied volatilities also on the options market are very small. Take a look at the VIX here. This is the weekly point change in terms of the VIX. Now, when the VIX, and it really hasn't moved a lot. You take a look at last week, the week before, it's been up or down a point. When the VIX is only up or down a point, again, it averages. It means the S&P 500 during those periods of time when the VIX doesn't really move, the S&P 500 averages around 3% for the quarter, 12% for the year. But when the VIX moves a lot, if we start to see a big spike up, 3 points up, 5 points up for the, in a very short period of time, that indicates that now the stock market has much more room to go up. So let's put all this together. We have a VIX that's telling us that we have a very quiet market condition. I would define it as complacent. We have seen some economic numbers that haven't really moved the markets. Number two, we have the mortgage spreads, which indicate that the banks are building in an extra amount of risk to the marketplace, more than what we saw during the worst part of the panic of 2019, 2020. So the banks see risk. The immediate market tone is complacent and quiet, maybe kind of comfortable. And the bond market has showed us an historic explosion in yield on the very short-term 1-month T-bill, while the rest of the market is very, very quiet. So what that's telling us is that at the moment, the market is expecting the Federal Reserve to continue to raise interest rates higher. Over the long term, the low 10-year agrees with the mortgage spreads. Risk on the horizon. Coming up this week, pending home sales, PCE, personal consumption expenditure, inflation numbers, durable goods, which weren't that hot remember the last month's durable goods. It was strong, but only because of a big Boeing order. And of course, GDP numbers. Moving forward, how can we prepare ourselves? If we see these numbers with a very, let's say, positive tone, durable goods show manufacturing. Remember, durable goods is a reflection of products that are meant to last more than 3 years, automobiles, washing machines. If that shows us that manufacturing and construction and all those types of industries are strong, and that the GDP shows us growth, and inflation maybe is chugging higher, that's going to tell us, hey, Federal Reserve has more reason to raise interest rates and license to do so, and it thinks that the market can handle it. It thinks that the economy can sustain those higher inflation numbers and GDP numbers. However, on the contrary, if we see durable goods orders, again, if it's a second negative number, if the inflation is still strong but the GDP is soft, that tells us something different. And I think that the way we're going to find out what the market thinks about all this, again, very simply, is to watch the bond market. Specifically, we want to watch the 1-month T-bill, this black line. If the 1-month T-bill continues to rocket higher and it pulls up the 1 year, then we know that the current status quo is going to continue. Short-term yields up, long-term yields down, an expansion of the inverted yield curve. However, if we see a reversal, a buy in the rumor, sell in the news, if the 1-month T-bill collapses, well, that could mean something different. And we've talked about this in our historical reviews of inverted bond markets, that when the short term starts to collapse, sometimes the stock market follows. And if that occurs, of course, we're going to revisit those charts as well. But either way, we're going to watch these numbers very carefully, and we'll be sure to update you along the way with any significant developments. We hope this has been helpful. We look forward to seeing you back soon.